Thank you for joining us for a monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thank you very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about the current state of real estate markets and where they might be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. And this month, I want to spend more time again looking at home prices. We'll know more about prices late next month when new home price data are available from the FHFA, and in particular about the speed with which the home price bubble will deflate. But investors can get an early feel right now for where prices will be headed in 2023. Price bubbles are usually disconnected from regular economic growth. They are the result of abnormal supply or demand. But the strength of economic growth for the US as a whole, and especially in local markets, has a large effect on how fast home prices adjust to normal levels. So let's first have a quick look at the economy. Here's one look at how the economy is doing, gross domestic product, and it's not very encouraging. Here we see the change in GDP every quarter from the same quarter of the previous year, adjusted for inflation. Growth in the latest quarter was just 1%. Here's one fundamental reason for the slow growth. New estimates for the population in 2022 show a small recovery after the large COVID deaths of 2021, yet still only an increase of 0.5%. An economy built on the continual expansion of its domestic market can't grow faster if the population doesn't grow. And this leads us to the job situation, which normally is an indicator of how well the economy is doing, but recently has been a jumble of new jobs and COVID recovery jobs. The growth rate of almost 3% in the past year would normally signal strong economic growth, but the steady decline we see in this chart suggests this is mainly an adjustment process back to a lower basic level of growth. We see the same pattern in manufacturing. And in retail, where growth is basically zero. At restaurants, the fastest growing part of the economy right now, new jobs are almost entirely recovered COVID losses. And in business services, the most important sector of the economy, which powered much of the recovery. We not only see the same pattern here, but also a very sharp decline that doesn't bode well for the economy. So now we get to home prices with the understanding that the economy will not be providing much support for home prices, which are much higher than incomes can support. Yes, prices in the fourth quarter were still 12% higher than in the fourth quarter of 2021, but it's clear that the dynamic change is heading in an unfavorable direction. Let's compare with the last bubble in home prices back in the mid-2000s. Back then, prices were in a lengthy bubble that then took many years to deflate. This time, the popping of the bubble will happen much faster, and there's no reason to think prices won't very quickly get into negative territory. Yet all markets won't deflate in the same way. Let's take a little tour around the country. Smaller markets that had the biggest bubble will have the fastest readjustment. Boise is the poster child here. Be sure to notice the 1% increases in prices in the fourth quarter. When we get first quarter data, Boise prices will certainly be in the red. In many of the Florida markets, on the other hand, like West Palm Beach, the deflation will be slower and possibly not as deep. Local economics will affect how fast and how far prices will fall. Most other markets are somewhere in between. Here's Atlanta. Austin. Charlotte. Chicago. Los Angeles. And Seattle. One further point, home prices will readjust for several years, though not as long as last time, but probably still well into 2025. That's it. In this time of uncertainty, let me plug our Investors Metro analysis, which analyzes home prices and rents, calculates investment risk, and provides strategic investment analysis for each local zip code. Available for 200 markets, it's written for investors, not economists. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.